Hey everyone, welcome back. Now in my last video, I talked about investing for beginners. So today I want to go into a little bit more detail and talk about the do's and don'ts of stock investing. Stock investing can be incredibly interesting to inexperienced investors. The promise of making billions of dollars just by moving money around seems almost like magic. In fact, it almost seems too simple to the point where it becomes really easy to make mistakes based on either emotion or psychological tricks that the market can play on you. This happens to both inexperienced and experienced investors, and it can cost you a lot of money. In this video, I'm going to go over 5 do's and don'ts for stock investing. Now, these tips and tricks are taken from interviews with various investors such as Charlie Munger and Warren Buffett, different books that I've read over the years, as well as just my own investing experience. These tips should hopefully protect you from losing a bunch of money. You still need to put in the time and effort to actually learn how to analyze the fundamentals of companies and to actually do that analysis, but the tips and tricks I'm going to show you here are applicable to all types of investing, not just investing in individual companies. So with that, let's start getting into the list. The first item in my list is don't price anchor. This can be summarized as the price at which you bought the stock doesn't matter. All that matters is the stock's current price and the price it's going to be in the future. Just because a stock was worth a lot in the past and then it dropped doesn't mean it's going to go up in the future. In fact, there's zero correlation indicating that it will go up. Sometimes I hear people in videos say something like, I bought this stock for $100 and then it had a bad earnings report and the stock price dropped. So I'm going to wait for the price to go back up. That makes zero sense. If it had a bad earnings report, you would expect the price to drop. So why then would the price go back up? The only reason you think this is because emotionally you feel like the price should go back to where it was before, but again, this is emotional and not rational. A good way to tell if you're price anchoring is to ask yourself, if I didn't already own this particular stock, would I buy it at its current price? If the answer is yes, go ahead, keep on holding the stock. But if the answer is no, you're price anchoring and you should sell the stock. The next item on my list is don't fall in love with a stock. Sometimes I'll hear about someone who's made a really good return on the stock in the past. Let's say it's gone up 75% in the last 2 years. And they think, I can't sell this stock, it's made me all this money in the past. Maybe they say something to themselves like, I'll just wait for it to go up to 100%. Best case, I make some money, and worst case, I just lose a little bit of house money. Well, no. There is no such thing as house money. If your stock goes down, you are in fact losing money. And if your stock goes up, yes, you are making money, but you shouldn't assume it's going to go up just because it's gone up in the past. I've had positions before where I've had a 96% return on a given stock. And sure, I could have waited a few weeks to maybe get it to a 100% return, but at the same time, during that time, it also could have dropped down to 50%. Again, a way to tell if you're falling in love with a stock is to ask yourself, if I didn't currently own this stock, would I buy it? Next, do buy companies, not stocks. This means to focus on what the company that you own is doing rather than what the price of the stock is doing. Now, if you're a technical trader, this doesn't apply to you because you're not an investor. See, technical traders look for patterns in the stock price and they use these patterns to try to determine what the stock price is going to do. If you're an investor, I would not do this, and I don't do this. The reason for this is a zero-sum game. Somebody else has to lose in order for you to win. And you're competing with PhDs and experts on Wall Street who have a lot more computing power than you. Instead, I focus on buying companies that will either be worth more in the future than they are today, or are currently worth more than the stock price says they are. Don't think of the stocks you own as just stocks. Think of them as companies and evaluate them based on the merits of the company. That way, you can determine whether or not a certain stock is going to go up faster than the rest of the market. Remember, in the short term, the stock market is a voting machine, but in the long term, it's a weighing machine. Do invest in a limited number of companies in a limited area of expertise. The fact is, there are just too many companies, too many industries out there for you to analyze all of them. If you try to learn about every single company that you think could potentially be a good investment, you're going to run out of time, and you won't be able to give each individual company its due analysis. You're much better off trying to focus on a very limited area of expertise. This is what Warren Buffett has done throughout his entire career. Now, granted, when you do this, you're going to see people who have stocks that vastly outperform yours, and you're also going to see people who have individual stocks which underperform you. It doesn't matter. You can ignore them because you don't own them. All that matters is if your own performance beats the market. It doesn't matter if you miss one stock that does really well, if you have 5 other stocks that do almost as well. You can't own every company, and the fact is, some companies will do better than the ones you own. What's more important is that you focus on picking stocks that will consistently beat the market. Don't try to time the market. Consistency is the key. Sometimes you'll see crowds that are all saying, buy the market, it's going to keep going up. And sometimes you'll hear them saying, you have to sell now, it's about to crash. Sometimes they're right and sometimes they're wrong. You can't really tell the difference, and the fact is, they don't know either. It's hard enough finding good investments in the first place without also having to determine when to invest. Just focus on making good investments and don't worry about timing the market. Consistency will work out better in the long run anyway. Now you may be thinking to yourself, well, I haven't followed all these rules in the past, and I've made money before. Sure, but remember, the stock market is almost unimaginably random. Any action you take could make you money one time, and then lose you money another time. What's important is if you can consistently make money in the market. That's what distinguishes someone like Warren Buffett, who's made over $100 billion in the market, and someone who just doubled their money once by making calls on Tesla. Consistency is the key. All of these do's and don'ts aren't focused around making you money once. The goal is for you to consistently earn a return on investment over a long time horizon in the stock market. Everything in the stock market is just averages, and you want, on average, to make good decisions. These will help you do that. Let me know if you've used these do's and don'ts in your own investing career, and also let me know if you think there's anything that I should have added to this list. If you liked the video, make sure to leave a like, and if you want to see more videos like this in the future, make sure to subscribe. I'll see you next time.